Good morning, everyone. Thank you for watching today. So we are here. I'm with Dwayne Graham with New American Funding. How are you doing, Dwayne?
Good, Gwen. How are you?
Good. So we're doing our weekly discussions about the mortgage rates, and everything in between. And so today we're going to talk a little bit about a couple of different things. Um, the first thing I wanted to talk about was the difference between the discount points and the origination points. And if you can
Yes.
please explain that for me.
Sure. It's a common question that I get asked quite a bit. What's discount points? What's origination points? So here's the difference between the two. Discount points, it's prepaid interest that you pay upfront for getting a lower interest rate. So it's a direct. It has a direct correlation on the rate, on lowering the rate if you want to. With origination points is what the lender charges to do the loan. Most lenders charge a 1% origination point just to do the loan. With us, we don't do that. We have a set fee that we charge for doing loans. So if your loan amount is 150,000 versus 500,000, it's the same set amount. What most lenders do is they charge you a percentage, the 1% origination, just to do the loan. So on a $500,000 loan, they would charge you 1%, $5,000 just to do the loan. So that's just their loan charges. With the discount points, it has, again, a direct correlation on the interest rate. So just as an example, say for instance, the rate that the person qualifies for is a 3.25. That's just what they qualify for without any points. They have the ability to apply points to buy the rate down. So they could go down to maybe like a 2.875 if they paid 1 point. And 1 point is 1% of the loan amount. So a lot of people confuse the discount point with the origination point because it's a percentage. Both of them are percentages.
Mhm.
So the difference again, it's one has a direct impact on the rate, and one is just what the lender charges to do the loan.
Okay. And so with your company, you just charge a set amount.
Yeah, it's a set fee.
Okay. All
So
right.
regardless of the loan amount, if it's 500,000, it's the same set fee. If it's a
Okay.
200,000, it's the same amount. So typically, whenever we look at scenarios, our lender fees are less than most companies because we have the set fee, and most lenders charge the 1%.
Okay. And then how should a person know or decide, if they need to do the buy downs?
So whenever I take a look at it, I look at scenarios with points and without points just to see if there's any benefit for the client. Typically, if it's a house that the person's going to be in for, I'd say 5 to 6 years, 99% of the time, it is beneficial because after that time frame, they start paying themselves back for the upfront investment of the points. Whenever I take a look at it for them, I run a calculation to see, hey, after these many months or this many years, you start paying yourself back. So it's based on the situation, but majority of the time, if you're going to be in the house for more than, I'd say, 5, 6 years, it usually is beneficial for you to get the points. If it's less than that, typically it's not.
Okay. Okay. Now that's good information to know because I do get a lot of questions about the differences
Yeah,
between the discount
between the
points
two.
and the origination points and how they work and stuff like that. So
Yeah.
giving people that information to be able to decide which one is the discount points, what it really stands for,
Hmm.
and how it's going to affect them is really good. So let's
Now,
talk about. Go ahead.
one quick thing on that topic as well, Gwen, is so most lenders know that buyers are more rate conscious than they are cost conscious. So
Right.
most lenders automatically put 1 point to make it seem like they're getting a better deal. The client's getting a better deal when they're not, because they know that clients look at the rate first and they worry about the cost later. So what most lenders do is, say for instance, they automatically assume that the buyer is rate shopping, that there's competition, they're competing. So if the buyer talks to the lender and the lender quotes a rate with no points, so let's say they quote the rate at a 3.25, the most lenders will automatically add the 1 point, buy the rate down to say a 2.875, and they'll quote the 2.875 because when the buyer is looking at or when they're talking to them about the scenario, they're focused a little bit more on the rate than they are about the cost.
Right.
So they're comparing a 2.875 to 3.25, where it's really not a good comparison because one has points, one doesn't have points. So very, very important. If someone's rate shopping, they should always ask for a scenario with points and a
Mm.
scenario without points. And I'd say just ask for a scenario with 1 point and a scenario with no points.
Okay. Okay. That's really good information then,
Yeah.
to help people kind of decide what they need to do. Okay. Wonderful. So now that we've covered that difference, let's talk about another difference. The difference between the APR and the note rate. If you can
Yes.
explain to us what
Sure.
each one is and then how it affects our mortgage and the loan.
Sure. Sure. So the APR and the note rate is what determines monthly payment. So in the example that I just gave, 3.25 and 2.875, that would be the note rate. It determines monthly payment. The APR takes into account the cost associated with doing the loan, adds it to the note rate, and expresses it as a percentage. So the APR doesn't really have as big of an impact on the monthly payment as the note rate, because again, the note rate is what determines monthly payment. APR is just the note rate plus cost expressed as a percentage. A lot of clients get the APR and the note rate confused because the APR is always going to be higher than the note rate because it's the note rate plus cost. But again, the thing that they would focus more on if they're concerned about monthly payment is the note rate, not the APR.
Okay. And what does APR really stand for?
It's the annual percentage rate, but when you think of APR, you think of something that affects your monthly payment. Like if you have a credit card, that's what you look at. You look at the APR. When it comes to mortgages, the APR it literally has no impact on monthly payment. It's the note rate plus the cost associated as a percentage.
Okay. Okay. Okay, that's really good. Okay, I love this information that you're
Yeah,
giving and
yeah.
educating us on
Lot
all of
of
these
good
different
nuggets.
parts. And hopefully it'll help some people kind of see the difference,
Yes.
between
Yeah.
in getting into the mortgage and really kind of understanding the different pieces that goes to
Yes.
the loan and stuff.
Yeah.
So
The
I
ins and
really
outs.
appreciate you taking the time out to do this for us.
No
Um,
worries. No worries.
so let's talk about credit report items because we know that, everything kind of revolves around the credit score, the credit report, and some things that comes onto the credit report. So some of the times when I see a credit report, I see on there we talk about the collections on the credit report. So how does the collections really kind of affect the credit report?
So depends on the collections. Some collections, all collections are going to affect the credit report. It's going to affect the credit score. But there's some collections when it comes to mortgages that it's not counted. It doesn't have any kind of impact on the borrower. Perfect example is medical collections. So any kind of medical collections, nothing is counted for the borrower. Yeah.
Okay.
Now, go ahead, Gwen.
Go ahead. Go ahead.
Okay. Now, another thing that I see quite a bit on the credit report is disputes. So clients who are going through credit repair, the credit repair person might be disputing accounts for them. If they're applying for a mortgage and there are open disputes, the open disputes have to get resolved before the file gets reviewed by an underwriter. If it is reviewed by an underwriter, the underwriter is either going to suspend the file or downgrade it to a manual underwrite. And with a manual underwrite, the requirements to get approved, it's more strict. Yeah.
Okay.
So it's recommended that the client get the disputes removed first before the file gets to underwriting.
Okay. And then when you see on the credit report that disputes, I think it says on there disputes or removed dispute. Does that affect the application too?
If it says dispute resolved, no, then that's fine. That's fine. They don't have to worry about it. But if it says dispute or dispute resolved and then client disputed after resolution, that has to get addressed.
Okay. Okay. And that could take a period of time to kind of they have to get with the credit bureau to get that taken care of, right?
Yes. So options are they can reach out to the credit bureaus. They can reach out to the company if they have somebody that they're working with that's doing credit repair for them. They can reach out to that person. That person can help, and we can even help. We have the ability to. There's a letter that we prepare. We send the letter to the client.
Wait, I lost you just a little bit. Hold on. You got muted. There you go. You kind of got muted there.
Okay, sorry. Yeah, so they sign it, send it back to us, and it just simply states that they're no longer disputing the account. Sign it, send it back to us. We send it off to the company that we pull credit with. They send it off to the credit bureaus, and then we get it removed. Now,
Okay,
that
wonderful.
process does take a little bit of time, though. It takes anywhere from about a week, week and a half.
Oh, okay. Okay. So you're not looking at like 30 days or something like that. But
No.
does it take that long to actually be able to see it, or y'all just deal with the letters when they come back and not
So we
really?
deal with it when it comes back. So what
Okay.
would happen is the client signs the letter, they send it back to us, we send it to the company that we pull credit with, they send it out to the credit bureaus. Within a week, week and a half, we'll get updates from the company that we pull credit with that the disputes are removed, and then we have to re-pull credit. Now, the reason why disputes have to get removed is when it comes to disputes artificially inflate credit scores. So whenever the bureaus are coming up with the actual score, if an account is being disputed, that account it's not taken into consideration.
Okay.
Yeah.
Okay. Let's talk just a little bit about medical, because I know a lot of people I've kind of worked with has some type of medical collection on their credit report. And
Mm-hmm.
so can you explain a little bit more about how the medical collections work?
Sure. So the medical collection, it affects their score. So it affects the score with regards to credit reporting, but for mortgage purposes, it doesn't affect them at all. So if they have a $10,000 medical collection, it's going to affect their credit score, but for the purposes of the mortgage, we don't count it at all.
Okay. Okay. That's great. That's great to know, because I know sometimes it could be a medical collection from a child, or,
Mm-hmm.
being that they hold an insurance card and stuff
Mm-hmm.
like that, that may not even know about, that happened, 6 or 7 years ago, and it's on the credit report.
Right.
And some people, they kind of like, okay, well, how am I supposed to deal with this? And what am I supposed to do to get
Mm-hmm.
that removed off of the credit? So that's good information to know also. But is
Yeah.
that with just your company, or is that all the way around when it comes down to mortgage approval?
Most mortgage companies don't count the medical collection. I think there might be a few who do, but most don't.
Okay. Okay. All right. Wonderful. So profits and loss. Um, how does that work on your credit also? And can you explain it a little bit to us?
Sure. So it's very, very similar to collection. So let's say somebody had a car, they fell on hard times, life happens, fell on hard times, and the car got repossessed.
Mhm.
More than likely, the company, the car company, or the finance company, they're going to write it off as a profit and loss, and it's going to show up on the person's credit report.
Mhm.
If it shows up as a profit and loss, majority of the time, it's not counted either. Yeah, but that part, I know that part, it may just be with us. I don't think every lender does it that way.
Okay.
Yeah, yeah.
Okay, because I was just going to say, I know some of them. I've had some clients who possibly co-signed on a car for their child or niece or
Hmm.
nephew and whatever,
Hmm.
and that car got repoed, and
Hmm.
and so it was on their credit report as a repo,
Hmm.
which kind of affected the ability to be able to get qualified or approved for a loan.
Yeah,
So
yeah.
with y'all, that's a little bit different.
Yes, yeah.
How
As
y'all
long as
look
it
at
says
it.
profit and loss, it's not considered as much. Some companies, yeah, they do. They're like, yes, we're going to hit you for this, but with us, no.
Okay, that's really, really good information. So it really does come down to who you choose as a lender
Yes, absolutely. Yeah,
when getting
we do.
qualified or getting pre-approved for a mortgage.
Yes. Because we're a direct lender, we lend our own money. Our guidelines, our requirements aren't as strict as most lenders. We do a lot of loans that most lenders either won't or can't do.
Okay. Okay. Great. Great. Um, let's talk a little bit about the interest rates now, or how things are going since we're coming out of COVID virus and stuff like that, and people are kind of, things are kind of picking back up, and businesses are starting to open back up and stuff.
Mhm.
How is the economy and stuff like that looking for buying a home?
So rates are still great. Rates are still low. If there's anybody who's thinking about purchasing a house, refinancing a house, selling, it's still definitely a great time to think about doing that. Our guidelines have gotten more relaxed now with everything opening back up. So we're seeing some benefit of everything opening back up, of everything starting to normalize, but rates are still great. We're still doing loans. If anybody wants to purchase a house, refinance, it's still a great time to do so.
Okay. Okay. Great. Great. So, any advice to our first time home buyers, or people who kind of are looking to buy and really, um, don't know where to start or what to do
Yes.
first?
Absolutely. First step is, reach out to a mortgage professional, reach out to a loan officer, reach out to your local bank, reach out to somebody, get an idea of where you stand and what you need to do next. At least if you can't get it done right now, the loan officer should give you a roadmap to what you should do to be in a better position so that you can get it done. Don't be afraid. Don't be afraid of the no. The no doesn't mean never. It might not, it might mean not right now, but it won't mean never. So first step, reach out to a loan officer, give them an idea of what you're trying to do, what you're trying to get done. They should be able to guide you, walk you through the process. Again, put together a roadmap of what you can do when you're ready.
Okay, wonderful. Well, I thank you so much for taking the time out to speak to me and giving
Always,
us this
always a pleasure.
education
Yes.
and information. And if you are looking to start the process of home buying and you are wanting to talk to Dwayne, can you tell them how to get in touch with you, Dwayne?
Sure. My cell number is 832-661-9060. Again, 832-661-9060. Or by email, dwayne.graham@nafinc.com. That is DW.
Oh, you kind of muted. Okay.
Okay, sorry. It's DWAYNE.GRAHAM @NAF, as in Frank, INC.com.
Okay. And if you are looking to buy and you want to just kind of talk to a real estate agent, you can always reach out to me, Gwen Ransom, with Remax Professionals, your intentional agent, at 346-702-6748. And please let us know if you have any questions about the mortgage process and loans, and how they can benefit you. Please let us know. Like this video, comment on the video, share it with somebody else who is thinking about the process and getting ready to go into it. Please share this video so that we can get this information and education out to more buyers. If this 2020 is not over yet, so you still have plenty of time to
Yes.
become a homeowner. So just get with us so we can set up a plan, see what it takes for you to become a homeowner, and we'll go from there. So thank you all for watching. I really do appreciate it. And until next week, see you later. Thank you,
All right. Bye,
Dwayne.
guys. My pleasure, Gwen.